Hello, everybody. It's Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, and one of the co-founders of Dividend King's marketplace service on Seeking Alpha. For this video, I'm going to talk about just exactly how overvalued the market really is. I've been talking about this quite a bit, but in conjunction with talking about how overvalued the market is, I also talk about the idea that it's a market of stocks and not a stock market. Nevertheless, the key to understanding valuation, in my opinion, is always earnings yield. That's the inverse of the PE ratio, if you will. And what the earnings yield tells you is if you owned 100% of the company or bought 100% of the company you're investing in, and that company then paid you 100% of all its profits, then the earnings yield calculation represents exactly the return that you would be earning on that investment. Now, I want to caution you when you're looking at earnings yields, that earnings yield is 100% of the money. No company really does that. What they do typically is they do pay a dividend, however, and that dividend usually represents what is called a dividend payout ratio, which is what percentage of the earnings the company actually pays you as a shareholder in the form of dividends. So with all that in mind, let's kind of get into the video today and look at where the S&P 500, using it as a proxy for the overall market, actually sits today, and we're going to do it in terms of earnings yield and dividend yield. Now, I've often said that I like an earnings yield of at least 6.5% to 7% because that's typically the long-term rate of return that stocks have generated, somewhere between 6 and 8% over 200-year periods. Now, there are times when stocks will do better than that. For example, if you bought the S&P 500 in September of 2011, when the PE ratio was under 12 and held it through yesterday's close, you would have made 15.7% per annum. Okay, that's where valuation really comes into play. Your earnings yield would have been significantly higher than the 6.5% to 7% number that I talked about. In contrast, had you bought the S&P 500, let's say in April of 2001, when the PE was just under 25, which is even less than it currently is today, and held that all the way through past the Great Recession. I'm going to go through the Great Recession. You end up with a negative rate of return, and that includes dividend income. Okay, overvaluation was the culprit here, and yet the market did reasonably well from a standpoint of earnings. So what I've got on this graph, and I just want to try to clarify this because when I do graphs like this for you, fast graphs, fundamentals analyzer, software tool graphs, you shouldn't just look at the graph. You should also study and analyze what the graph is actually showing you. So let's kind of do that here with the S&P 500. First of all, the orange line represents a PE ratio of 15. Okay, that is a normal 200-year average valuation for the market. The numbers range between 14 to 16 or 18 even, and depends on how you measure that. But a 15 PE, the famous Ben Graham once said he never paid, more than 15 times earnings. He said, you should never pay more than 15 times earnings. That's kind of a representative fair value metric, and it represents an earnings yield of 6.67%. Okay, if you divide it, it's simply the inverse of the PE, which would be the earnings yield of 6.67. So when the stock is touching the orange line and trading at a PE of 15 or so, you're getting an earnings yield over 6.7% or 6.7% and over. In contrast, when the PE is very high, like it is today, when you're looking at a blended PE of 27.5, your earnings yield is only 3.6% or half that. And that's just a great indicator because use common sense when you're looking at that. If you were going to own 100% of the company and you invested all your money in it to buy it, and you were only going to get 3.6%, would you consider that worth the risk of investing all your money? And I would argue that common sense would say the answer is no. But remembering that the market, just like stocks, only pays out about 40% of its earnings, even less in some cases, as dividends, your dividend yield is only 1.42% currently. That's an extremely low yield. So another way to look at valuation here is to realize that when the market was really undervalued, the dividend yield of the S&P 500 was over 3%. When it was reasonably valued back here in these time frames, you could get over 2%, routinely on the market. Last year, the market ended right here, overvalued, and you were getting 1.54%, and now valuation's even higher, and your dividend yield is only 1.42%. Another indication that the market is extremely overvalued. So the 15 PE ratio line is a valuation reference, and then the normal PE ratio is simply a trimmed average multiple that the market has historically applied over whatever time frame is being graphed. Now, just to be clear, if I change the time frame, this now drops to 16.87, which is very close, by the way, to what I showed you when I did the all graph here. So these are reference lines. The key is, when you're looking at this graph, recognize that the blue line is a PE of 17.8 rounded, which means if the price is touching that, that's approximately what the PE ratio of the market would be at that time. If the price is below that blue line, it's a lower PE, and if it's above that blue line, it's a higher PE, okay? Same goes with the orange line. When the price is below the orange line, it's less than a 15 multiple, and so on. And what you see here analyzing this is that the market tracks between those lines most of the time, even during this really what I would call, wacky market that we've been in, even since the 2001 recession, where, this was coming out of the irrational exuberant period. Valuations were very high. That led to the infamous lost decade where, investors actually didn't make any money for 10 years during the decade. And then we hit the Great Recession and we saw earnings drop. And then we had really incredible valuations. Now, Warren Buffett famously stated around this time, investors need to be greedy when others are fearful and fearful when others are greedy. So what he was saying is everybody was fearful here. This was a whole period of fearfulness, if you will, where market values got very low. You could buy the S&P at PEs under 15 quite often during this time frame from 2008, 2009, 2010, and even into the majority of 2013, you could have bought the market at a very attractive valuation. Now, by doing that, you are lowering your risk while simultaneously increasing your rate of return. Because instead of having a lost decade, had you bought it here at the trough valuation of the market in September of 2011 and held it to today's overvaluation, you'd average, as I showed you earlier, almost 16% a year annualized. Big difference in your rates of return. Now, I also had some comments recently where people were suggesting that, this isn't a long-running bull market anymore because it's really a very short-running bull market because the bull market ended during COVID. Well, obviously it didn't. If you look at this graph very carefully here, you can see that, in December of 2019, the market was at a very, high valuation. The PE was just under 20. And then we had, the COVID come and we had the flash crash, which did give us that 20% drop in value. That was a very, immediate crash. That's why I refer to it as a flash crash. But then we recovered dramatically. The market never really got into fair value. At the very best, it got, slightly below its full valuation number, which is the 17.75 on the graph here. So this has been a bull market. This bull market has run since really February of 2009, which was the throes of the Great Recession, till today. And we've had this bull market. Now this was still a bull market, even though valuations were normal. This was a period of rising stock prices. Then we got into this high valuation level here. In the last 3 or 4 years, valuations have got extremely high. Okay, and lately, we've been seeing some softness in the market, as I'm sure most of you have noticed. And the reality of that is simply the fact that we're hitting these peak valuations because no matter where I look on this graph, I never have had a valuation that was this high. The closest I come to that was April of 2001 that I showed you earlier, where the PE was just under 25. Today, the blended PE is 27.5, one of the highest ever. Now, from a forecasting point of view, the market is expected to grow about 5% this year, the earnings of the S&P this year. And that's typically in line with normal growth. I want you to notice the historical normal growth rate of the market over this time frame has been 5.91%. That's measuring it from here all the way out to this dot here. That includes estimate data, in other words. Now, if I cut a little bit of time off of that, now the growth of the market goes up to 7.59%. So keep in mind, these are dynamic calculations. I take a few more years off just before coming into the Great Recession, and we're back down to 5.24%. So when I'm using the forecasting calculator, it's rational to go ahead and use the historical growth rate of the market as a proxy. And I can look at all those numbers here over all these years and see that, we're looking at a 6 or 7% growth rate on the high side, 5 or 6%, on the low side. Now, we did have a couple of years of very high growth in the most recent years, and we'll go back and look at that. But I want to point out something. Those periods of growth are averages that come and go because they're typically followed by weakness. For example, we had 11% growth in 2017, then 22% in growth in 18. Then, of course, we only had 1% growth in 2019. And then we had the minus 15% earnings growth in 2020, which was COVID. And by the way, that's a pretty remarkable number. Now, the 25% growth we had in 2021, or we're expecting for 2021, is actually functionally related to the fact that we're coming off such a low base here. So keep that in mind. If I connected the line from here to here, that would be more of a trend line growth rate. So no matter how you measure it, the S&P is massively overvalued right now. Now, if I actually go into the S&P 500 and look at it individually, because as I often state, it's a market of stocks, not a stock market, I'm going to look at the earnings yield. And I've organized this by earnings yield. Well, I want you to notice there are a lot of companies here that have zero earnings yield because they have no earnings. On the other hand, you can take a stock like Under Armour that has 0.4% earnings yield. Think about that. In other words, if you owned 100% of this company and they gave you 100% of their profitability, you would only earn a yield of 0.04%. That's because the price is just so massively overvalued here, as you can see. Now, you can also see that the price was massively overvalued back in March of 2016. But this blended PE is like 2,500. That's why you've got such a low earnings yield. But that's because the earnings here, the blended earnings number is so low. It's just a matter of pennies. It's not even, a lot. So you also want to remember it's a market of stocks and not a stock market. And it really depends on the individual companies you're looking at. So, for example, I look at a real high quality company like Church & Dwight, Arm & Hammer Baking Soda. I see a company that prior to coming out of the Great Recession pretty much traded at that, 15 times earnings. The market did like to put a premium valuation, which is a normal PE of 22 here, but you can see that that valuation has really stepped away from that. Now, this has lasted for several years. Nothing I'm saying here says that the market can't overvalue stocks for several years. The point is, though, I call this musical chairs. You're playing musical chairs with your money when this is happening. As long as the music is playing, you can gleefully dance around the chairs and everything is fine. But you don't want to be there when the music stops playing. For example, I've shown this so many times in recent videos and articles. If I look at a stock like Albemarle and look at it from a standpoint of valuation in this musical chairs concept, you can see this is a relatively cyclical company. It's a lithium producer, which is obviously, the Green New Deal, Tesla, the greening of America, because lithium batteries is what's driving all that stuff. Well, you can see that the stock tracked its earnings so beautifully all these years. Then we got all the hype about the, Tesla and the electric vehicles and so on. And then the stock price ran up dramatically, but it also had a couple of good earnings years. But then when it was up here at this significant overvaluation, we had this huge collapse. And now we're running it back up into high valuation. So the point is that the market is overvalued, but it is a market of stocks and not a stock market. In contrast, we got American Airlines, and we all know what happened to the airlines during COVID. Now, they are expected to start growing earnings again, okay, in the future when everything resumes and the COVID crisis is finally past us, which, hopefully that's happening right now as I'm producing this video. But the point is, you see the relationship between fundamentals and earnings, but you've got an earnings yield here that isn't even calculable on American Airlines because they have huge losses for 2 years in a row. When they start earning money again, then their earnings growth could end up being, rather spectacular because they can go back to their normal earnings power, but that doesn't mean that the business is actually growing. You've got to take that into consideration. This is a very interesting stock, Paycom here, which is, application software. You can see that it's had a very high growth rate. The only time a low earnings yield makes any sense is if you're going to get very, very fast growth. But there's even a limit to that. Because, for example, here we had a PE of, we'll call it 50. The PE ratio of 50 represents an earnings yield of 0.02%. Now, That can be okay if you got a company like Paycom here, where, if I use this period of time here, 12/31/2018, when the PE ratio was right at 45, had I bought the stock there and it continued to grow at 47%, so that's kind of a P equals growth rate concept, you could have generated a 23% rate of return. The point is, you can have a very, very low earnings yield as long as your earnings growth is very, very high. But now in the case of Paycom here, if I look at forecasting, the company's still expected to grow very fast at 25% a year. But the problem is 25% growth does not justify a current PE of 89.45, because even if the company accomplishes that, you would still lose money over the next 5 years. So this concept of earnings yield is critical, but it's also a market of stocks and not a stock market. And it's also important to know what the earnings of the company are going to be going forward. So there are companies like Prudential Insurance Financial here, A-rated, 22% debt, that is very, very attractive, even in this overinflated general stock market. You can buy Prudential at a blended PE ratio under 9. That's an earnings yield of 11%, which is roughly twice the earnings yield that I require. And it gives me a dividend yield of 4.57%. And as you can see, during COVID, the stock did get ridiculously cheap. The PE fell to 4. And what a marvelous time to buy the company, because since March of 2020, you're talking about a year and 3 months here, you'd have almost doubled your money. The stock went up 93%, averaging a 79% annualized rate of return. And now if this stock continues to move up, which I expect it will, to its normal multiple, you're going to be averaging 50% a year had you had the foresight to buy it when it was inexpensive like this. The point is that you want to be greedy when others are fearful. This was the time to be greedy with Prudential. But when you're dealing with these very high valued stocks, you have to go the other ways. Bristol-Myers, another example. You want to be greedy when the market was fearful here. And you want to be investing when you can buy it at very low valuations. What you don't want to do is go into these stocks when the valuations are extremely high, like some of these others that I've showed you here, where you've got these crazy valuations and no growth. It is a market of stocks, not a stock market, but the general market is very, very high right now. I would call it massively overvalued. Consequently, it's time to be nervous, especially if you have a catalyst that could really change things. And that catalyst appears to be the fear of inflation right now, and even possibility of rising interest rates to fight inflation. That's something a lot of people are talking about, a lot of people are asking me about. And I think that's, those kind of fears are why this is the market as I'm looking at it right now on Yahoo Finance. That's why stocks have been faltering here for the last several days. We've got this fear of inflation. We've also got fear of a significant increase in taxes as well. So there's a lot of reasons why the playing with the market today is extremely dangerous. And I would be very, very worried, but I'd be focused on the stocks that I owned, and I'd be focusing on the earnings yield that each of them represent, and I'd be focused on whether or not they're, defensive positions going forward or not. The way to fight inflation is to earn as much money as you possibly can. Now, that can be through dividend growth or through a combination of dividend growth and capital appreciation. But the point is, you don't want to be holding very high-priced stocks when this music stops, because unless you've got strong fundamentals supporting your investment, you're going to suffer potentially very, very long-term, destruction of capital and very poor rates of return. Valuation matters, and it matters a lot. Anyway, this has been Chuck Carville saying thanks for watching. Hope you enjoyed this video. Give me a like if you do. Ring the bell so you can be notified of future ones. And, of course, subscribe to the channel if you haven't already. Thanks again. Be talking to you again real soon.